Hi, welcome to Market Minute. So this week we're going to talk about the all-important CPI report on Wednesday. It's all important because we have a valuation problem in the overall market. We need lower inflation so the Fed can cut rates so the 10-year Treasury can drop. Now what's concerning us is we see energy prices have gone up. Oil prices have gone up recently, and on a year-over-year basis can become a real big problem in May, June, and July, where the comparisons versus a year ago are very easy. We're going to talk about some names that we've talked about in the past, some big cap names and what to do with them, and then focus on some really interesting biotechnology stocks. So the stock market itself, we showed this graph before where you have the earnings yield on the S&P 500 of roughly 4.7%. The 10-year Treasury, it's now up to about 4.4%. So they're both about the same. Usually there's quite a bit of difference between the two, that the S&P 500 earnings yield is usually about 1.6% higher than the 10-year Treasury, or at least 1% higher. So they're getting to be about the same, which is causing a problem for the overall market. As you know, the market valuation is getting high, and interest rates really haven't dropped because inflation's sticking around, doesn't allow the Fed to cut interest rates. So generally, this is not a big problem until the market really starts to focus on it and says, okay, this is a problem, it needs resolved. So in 1987, we saw a kind of similar pattern as what we're seeing, is that the stock market continued to go up, the valuations got stretched, and interest rates continued to rise. So it made the 10-year Treasury or bond yields much more attractive than stocks. And bam, in October of that year, we had a very significant bear market all in one day. So these things can happen very quickly. So it's something that we're very aware of and focused on the CPI report. If you look at the CPI report, the CPI numbers have been coming down. So coming down nicely. You can see the blue line here, the all items. So it's been coming down nicely, but it's kind of stuck at that 3% area. And it's come down because of food and energy have moderated quite a bit, particularly energy. If you exclude food and energy, you can see that CPI has been rather sticky at around 4% because of the service side of the market. So we can't afford to have higher energy prices, higher food prices, which is kind of what we're approaching. If you look at the month-over-month numbers, so we had really good numbers in October, up only 0.1%. So that's very mild inflation. And then November, December, up 0.2. So again, if you analyze those numbers, it's close to 2% inflation. And then in January, it picked up to 0.3%, and in February, 0.4%. 0.4%, analyze that, that's 4.8% inflation. That's too high. So we're concerned that we may get inflation coming in at 0.3 or 0.4 on Wednesday, and it being too much for the overall market to sustain. So if it's 0.2%, the market's going to be delighted about it. However, as we go into May, June, and July, if oil prices stay where they are, these inflation numbers on energy are going to flip to the positive side and cause an inflation problem. So energy down 2% year over year in February, that was good. However, we think it could be up quite a bit as we go through that May, June, July area. So to us, that's the big inflation concern that we have, and likely will prevent the Federal Reserve from cutting rates in June or July. So the earnings reports, we get the banks on Friday. Generally when the banks are all higher, there's not a lot of concern in those stocks. They don't perform very well off the earnings. That's kind of what we're expecting on Friday, that the stocks are up all kind of nicely from the bottom in late October, early November. And so we don't think that there's going to be a whole lot of movement off the bank earnings on Friday. And then some of the stocks that we've been, investing in, talking about on this channel and our Market a Minute pieces. Raytheon was one that we picked off very nicely. So, they had somewhat of a problem in their jet engine division, and that looks like it's being resolved. The stock from $70 up to over $100. It's been a really nice mover. This is a great way to play defense as well. So we think that this is a core holding, and we still like the stock. We think it's still going to perform very well going forward. ConAgra is starting to move. So they had a reasonably good quarter. So it's heading in a nice direction. So stock went above 30. They have a nice dividend yield of somewhere close to 5% on that stock. So we think that the trend on ConAgra looks good. J&J has been kind of a struggle. So, it's lower than where we bought it. We bought it roughly at 160 or 158, something like that. It's 152. They made a nice acquisition of a cardio device here last week. I think that'll help their long-term growth rate nicely. And we don't think that the talc powder litigation's really going to ultimately end up being any major problem for the overall company. They can easily fund those liabilities. So we're somewhere probably around a bottom in the stock. So we like J&J quite a bit. And then Western Digital, WDC, this is a recent purchase. Still like it. AI obviously needs a lot of memory. So this is a way of playing that trend. We think that Western Digital probably has a pretty good quarter and has the wind at their back for a couple more years at least as the artificial intelligence trend plays out. Hewlett Packard, kind of the same sort of idea. People are going to have to upgrade their computers. But Intel, we're kind of disappointed in what came out last week about their foundry not being profitable until sometime in 2027. That's a very long time in stock market terms. It's beyond our time horizon to really hold on to the stock. So we're looking at potentially exiting our Intel position. So our emerging healthcare strategy, we see a lot of opportunities. These companies are all kind of related. Journey Medical, ticker symbol DERM. FBIO was the creator of Derm. FBIO owns roughly half of Journey Medical, so roughly half of Derm, which equates to about $35 million to FBIO, which is about where the stock price is for FBIO. So we think FBIO is very undervalued. And FBIO, just remember, also owns Checkpoint. And they also own a lot of other private assets that they are going to monetize. But Journey Medical to us is, if there's a no-brainer in this space, this is kind of a no-brainer. It's a market cap of roughly $70 million. They already have revenues. They have revenues about $80 million. So they have some really good dermatology products on the market already. They have a rosacea drug that will likely get approved on November 4th. That drug over time will probably do about $300 million in revenues. So it's better than the current standard of care, by a lot actually. So it'll take a lot of market share from the current standard of care. And we see roughly in 3 or 4 years out that they'll likely be able to do about $300 million revenues off of that one product, potentially more. So be very conservative about the valuation. You can generally put 4 times on revenues for a biotechnology or a drug company for the valuation. If you put 2 times on this, you get a stock price around $700 million, $800 million total for the company. So it gets us more in a 10x sort of return over the next 3 years. So we like this one a lot. Stock's roughly $3.50 to $4 a share. We think it's going to go to $30 over time, and probably over the short term, maybe up to $8 back to its old high. FBIO, it's going to take the ride with them. And again, there's some other things that's happening in FBIO that make it really compelling. And then I want to mention Checkpoint again. Checkpoint will likely get their drug approved this year a really interesting cancer oncology drug. So we like Checkpoint quite a bit as well. If you look at our healthcare strategy, so we like to have 10 to 20 names in a portfolio. We do it through a separately managed account for clients. And our returns have been somewhat volatile because of the volatility of the overall sector, but have had really good returns over the long term. So we think that we're seeing a lot of opportunities in this overall space. So there's roughly 700 biotechnology companies out there, and we're selecting 10, currently around 10 to 12 different names in the portfolio that we have a high degree of confidence in, that have really big upside potential, like Derm, with relatively low risk to it as well. VerU is a play, we've mentioned this before, on the obesity market. What their drug does is it signals your muscles to grow. So lean muscle mass is a big problem if you're losing a lot of weight. So the obesity drugs have been really, really popular. And the issue with them is the muscle mass loss and nausea as well. So this is a nice way of playing, having lean muscle not go away if you're on these drugs. And also, if you just want lean muscle as well, maybe you'll get approved for that broader indication. So we bought the stock in the 40-cent range. Yes, 40-cent range, and it's now over $1, and it's been, roughly less than a 2-month period of time. So we're seeing a lot of our opportunities in the biotechnology space. We think if the Federal Reserve can cut interest rates, this sector is going to move in a very big way over time. So thank you very much. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. We go over things in more detail there. And then please hit like and subscribe to the YouTube channel. Take care.